Good evening, ladies and gentlemen. I'm Karthikeyan, moderator for the conference call. Welcome to Q3 FY26 earnings conference call for Aequs Limited. As a reminder, all participants will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone telephone. Please note this conference is recorded. I would now like to hand over the floor to Mr. Diwakar Pingle from EY. Thank you, and over to you, sir.
Thank you very much, Karthik. Good evening, good morning to all participants on the call, depending on the geographies you logged in from. We welcome you to the Q3 and 9-month FY26 earnings call, the first earnings call for Aequs Limited post the listing. Before we proceed this call, let me remind you that the discussion may contain forward-looking statements that may involve known or unknown risks, uncertainties, and other factors. It must be viewed in conjunction with our business risks that could cause future result, performance, or achievement to differ significantly from what is expressed or implied in such forward-looking statements. Please note that we have mailed the results and the same is available on the exchange. In case you have not received the same, please write to us and we'll be happy to send the same over to you. To take us through the results and answer your questions today, we have the management of Aequs Limited, represented by Mr. Arvind Melagiri, Executive Chairman and CEO, Rajiv Kaul, Managing Director, Dinesh Iyer, Chief Financial Officer, and Harish Bang, Vice President Finance. We will start the call with a brief overview of the quarter gone past and then conduct the Q&A session. With that said, I'll now hand over the call to Arvind. Over to you, Arvind.
Thank you, Diwakar. Thank you. Good evening, everyone. Thank you for joining this call, the first one after our becoming public company. This is an important moment in our journey. The strong reception to our IPO, which was subscribed more than 100 times, reinforces the trust placed in us by our customers, partners, and our shareholders. This also reflects the confidence placed in us by our investors and the dedication of thousands of colleagues across manufacturing clusters in Belagavi, Hubballi, Koppal in India, and units in France and US. As you may know, Aequs began its operations in 2006-07 as part of Quest Global, with the ambition of building a resilient, scalable institution for a long term. Early customer insights showed that aerospace success would require a fully integrated manufacturing ecosystem. This led us to our first facility in Belagavi in 2009-10. That milestone marked the start of a multi-decadal journey to build a world-class manufacturing ecosystem in India for the world. The focus was also on maximizing in-country value add. We originally started with about 20% in-country value add. Today we have evolved into 100% in-country value add for select parts like aircraft wheels for the global commercial aerospace industry. Today, Aequs is the only precision component manufacturer operating within a single special economic zone in India to offer fully vertically integrated manufacturing capabilities in the aerospace segment. This sets us apart from other manufacturers with selective manufacturing capabilities amongst the suppliers across the world. This unique approach gained global acclaim in 2016 when Airbus conferred Aequs an Innovation Award in recognition of unique ecosystem that we have built here in Belagavi. Subsequently, our scale, capabilities, and compliance-driven approach in aerospace segment has enabled us to venture into consumer industry with a unique value proposition through manufacturing ecosystems. We strongly believe in partnerships and treating people equally. This led us to rebrand as Aequs in 2014, reflecting our view that all stakeholders are partners in growth. Aequs in Latin means equal. This philosophy has embedded in our values of transparency, trust, and respect, and institutionalized as a DNA of Aequs. Quite naturally, we have leveraged global partnership to enhance these ecosystems through joint ventures to gain deep process capabilities. We have partnered with Magellan Aerospace of Canada for surface treatment, with Auburn Duval of France for forging. More recently, we have partnered with Axel India and Aequs Defense to enter the design and manufacturing of unmanned aerial vehicles, primarily for India defense requirements. In consumer segment, we partner with Brazilian multinational Tramontina to tap the global cookware market. We have thus emerged as one of India's largest end-to-end aerospace suppliers to OEMs, Tier 1s, and such as Airbus, Boeing, Collins, Safran, Saab, Honeywell, to name a few. In the consumer verticals, we apply the same engineering discipline to produce precision components for consumer electronics, toys, and cookware for global leaders. Many of our relationships with the top OEMs in the aerospace segment and clients in the consumer industry span over a decade. This is a validation of a trust that we have built as a reliable partner with scale to meet their growing demands. Speaking of the industry scenario, aerospace and consumer segment have addressable market at over $447 billion and $126 billion respectively by 2030. Speaking of the opportunity in the commercial aerospace market,
Participants, kindly stay connected while we connect the management back on the call.
Yeah. Again, I think I will repeat this sentence in case if somebody missed. Speaking of the opportunity, the commercial aerospace market for the Indian supply chain companies.
This market opportunity, we still are, India is only 2% of the global supply chain, whereas currently about 5% of the global market India has. And this is going to go into a 10% of the global market. India is going to be a 12% of the global market for a commercial aerospace industry. And our focus has been to grow India as in line with the global market, what India opportunity provides. This dynamic offers the tailwinds for India manufacturing, including the cost competitive skilled engineering talent and rapidly maturing quality ecosystem. To capture a growing share of global aerospace sourcing, particularly OEMs, diversified supply chains to leverage India. Coming back to this quarter's performance. This quarter's performance reflects the strength in our operations, which we will discuss in further details during the call. The growth was driven by ramp up in the aerospace programs and scaling up in a consumer business. Our aerospace segment continues to be profitable with a strong order book of $814 million. In consumer electronics, the programs we won earlier are now industrialized. We are starting to see the revenues coming through. During the quarter, we received the approval from MATI for PLI incentives under Electronic Component Manufacturing Scheme. Further, we brought on Metal as a new customer and started shipping. Shipment started the last quarter in the Q3, and we started recognition of revenue. As we step into the new phase as a listed company, our focus remains unchanged to deepen capabilities, expand our integrated ecosystems to support our global customer programs from India. Thank you once again for your trust and support. I will now hand over to Rajiv Kaul, the co-founder and managing director, who will walk you through our operations and roadmap in greater detail.
Thank you, Arvind, and thank you everyone for joining us today. We are grateful for your time and interest in our company. As Arvind explained to you, we are a precision manufacturing company. We make complex, high-quality components for some of the world's biggest brands, which include almost every aerospace OEMs, Tier 1s, and consumer companies, including a large consumer electronics brand. Our manufacturing presence is vertically integrated, meaning we manage the manufacturing process end-to-end. It starts from forging, machining, molding, stamping, special process, various secondary processes, and assembly. Everything is done at our 3 integrated clusters in Belgavi, Hubli, and Koppal, supported by facilities in France and the US. This setup has kept us close to customers while at the same time capitalizing on India's position as a value-oriented supplier. Our integrated ecosystem gives a strong operating leverage, shared infrastructure across ecosystems, and delivers faster cycles and better cost efficiency. We have built deep process expertise across forging, machining of titanium, high-strength aluminum alloys, steel, and superalloys, supported by NADCAP certified surface treatment that meet stringent aerospace standards. These capabilities require years of investment and qualification, making them difficult to replicate and establishing a strong competitive moat for our business. In terms of manufacturing capability, we can handle large, long-term aerospace programs, as well as short-cycle consumer production at high efficiency. We currently operate around 3.96 million machining and molding hours annually, which is supported by our 424 CNC machines and 161 molding machines. Now I would like to explain our two segments in detail, aerospace and consumer. In aerospace, we manufacture critical parts of aircraft for aerostructure, actuation, engine, landing gear, and interiors, with a comprehensive portfolio of 5,221 parts as of December end. These programs are highly regulated and qualification cycles are long, but once approved, they tend to stay with us for years, which gives us visibility and sustained growth. The aerospace industry is also difficult to enter, but is a large runway for entrenched players like Aequs. This vertical contributes around 86% of our revenues during the 9-month period of FY26. Global OEMs are increasingly rebalancing their supply chain and turning to India as a reliable manufacturing partner. And as Aequs, we are well positioned to benefit from this shift, offering a fully integrated global certified ecosystem that delivers consistent quality and scalable capacity, supported by strong engineering talent, competitive cost structure, and efficient SEZ operations. We have seen meaningful growth in sourcing from major OEMs, including Airbus and Boeing. In consumer, we apply the same precision and discipline to make components and products for consumer electronics, toys, and cookware. While this vertical contributes 13% of our revenue during the 9 months, we are seeing rapid expansion of demand in this segment. At the end of the quarter, our aerospace order book stood at $814 million. During the quarter, we also commenced deliveries to Meta, and the consumer electronics programs awarded earlier have been fully industrialized, with revenues now beginning to flow. Before I close, I would like to highlight one thing that truly defines Aequs, our people. We have a strong team of 725 engineers out of total workforce strength of over 2,968. That reflects a significant investment in our engineering capability. They are the reasons we take a new product development to commercial production with speed and precision. We'll continue to build on this strength. With that, I would like to thank you for your time, and we'll hand over to Dinesh Iyer, our CFO, who will walk you through the financials and the key highlights for the quarter. Thank you.
Thank you, Rajiv. Good evening, everyone. I'll be taking you through the financial highlights for the quarter and the first 9 months of FY26. For Q3, revenue from operations stood at INR 3,262 million, reflecting a strong 51% growth year-on-year, which is also the highest quarterly revenue for Aequs Limited, driven by continued growth in the aerospace and consumer verticals. We reported an EBITDA of INR 381 million, up 353% year-on-year. This translates to an EBITDA margin of 12%. PAT for the quarter was at INR negative 426 million, but this includes both the impact of the labor code expense and IPO-related expenses amounting to INR 167 million. Our adjusted PAT after removing these one-time items would have been a negative 259 million. For 9 months FY26, revenue stood at INR 8,633 million, up 28% year-on-year, and once again led by strong momentum in the aerospace and consumer segments. Our EBITDA grew 85% from INR 662 million to INR 1,222 million, improving our EBITDA margin from 10% to 14% year-on-year. We have also been able to reduce our PAT loss from INR 1,115 million in the 9 months FY25 to INR 593 million, an improvement of 47% year-on-year. If we adjust for the one-time labor code expense and IPO-related expenses, our adjusted PAT for the 9 months would be a loss of INR 426 million. Coming to our JVs, if we include our proportionate share of the joint ventures that we have, total adjusted revenue for Q3 stood at 3,554 million, up 49% year-on-year, while EBITDA grew 228% to 449 million rupees, resulting in an EBITDA margin of 13%. For 9 months, revenue including JVs would be 9,482 million INR and EBITDA INR 1,410 million, reflecting a 15% margin, with growth in revenue of 29% and EBITDA growth of 75% respectively. Our aerospace joint ventures continue to deliver strong margins, reinforcing the integrated ecosystem that differentiates Aequs from forging and special processing to machining and assembly. In Q3, the aerospace business contributed INR 2,685 million, translating to 82% of consolidated revenue. Aerospace revenue grew 38%, with segment EBITDA at 633 million, which was up 163% year-on-year. For 9 months, the aerospace revenue was 7,424 million, which showed an increase of 26%, and segment EBITDA was 1,803 million INR, which reflected a 62% year-on-year growth. The consumer vertical reported revenues of INR 577 million in Q3, up 157% year-on-year. While our EBITDA loss in this segment widened from 95 million to 159 million, this is primarily due to us being in a scale-up phase. As our utilization improves with scale, we expect operating leverage to improve our profitability. For 9 months, the consumer segment revenue increased to 1,209 million, showing a 39% increase, and segment EBITDA fell to 159 million, which was a 9% year-on-year. Turning to our balance sheet, total assets stood at around 30.5 billion INR in December versus 18.6 billion in March 2025, reflecting IPO proceeds, investment in capex for consumer segment, and increase in working capital in line with business growth. Coming to the key ratios, our balance sheet metrics continue to improve. Net debt to equity reduced sharply to 0.1x as of 9 months FY26, reflecting deleveraging following the IPO and improved capital structure. Due to significant capacity additions in consumer segment, fixed asset turnover moderated during the period to 0.84x from 1.3x. Excluding the capacity addition in consumer segment, which is starting to deliver revenues, the ratio would have been 2.14x. The ongoing ramp-up across consumer programs is expected to improve utilization. Net working capital days stood at 120 days of sales as of 9 months FY26, broadly in line and showing a slight improvement over FY25, which was 132 days on sales, reflecting the long cycle nature of aerospace programs and inventory build to support growth. Aerospace segment ROC was 18.5% for 9 month FY26, reflecting a good improvement over FY25, which was 14.3%. This was driven by the operating leverage. Consumer segment, being in a ramp-up phase with investments front-ended, shows negative ROC, which is expected to turn positive as utilization increases. To summarize, top-line growth remains strong, margins are improving driven by operating leverage, and our balance sheet is well capitalized to support growth. Aerospace, being our mature business segment, continues to anchor profitability, while the consumer segment will move towards profitability with increased capacity utilization. Our priorities remain clear. First, continue to grow aerospace segment profitably. Second, drive utilization in consumer segment on the back of customer additions. And third, continue to look for opportunities in aerospace related to defense. With that, we will now open the floor for questions. Thank you.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. If you have a question, please press star and 1 on a telephone keypad and wait for your turn to ask the question. If you would like to withdraw your request, you may do so by pressing star and 1 again. Ladies and gentlemen, to ask a question, please press star and 1 on a telephone keypad. Wait for a moment while the question queue assembles. We have the first question from the line of Bhavika Singhvi from Niveshaay. Please go ahead with the question now.
Hello, am I audible?
Yes, ma'am, you're audible, ma'am.
Yeah. Firstly, many congratulations for the IPO debut and for good set of numbers. So basically, I have a few questions. One around your business side. As an aerospace company, I just want to know the management view, why they entered on the consumer segment, especially on the plastic engineering, and going forward, what's their view on the same? And the second question I have regarding the the results, like I see the margin, the consumer segment margins of Q3 have been like impacted. So I want to know the reason behind it. Like even though you are doing good on in terms of electronic side, so why there is a like margin got impacted in Q3?
Okay, this is Arvind Alighieri. Back in 2016, 2017 is when we expanded into consumer from aerospace. The thesis at that time was our capability, if you really look at precision manufacturing, and also the requirement, what is required for the industry, toys industry, was pretty much similar with respect to the compliance and also the regulations, in a sense, if you look at it, compliance, regulation, and safety side of it especially. And the global customers who came to India, they were looking for manufacturer with a background of aerospace, automotive, that kind of thing. And we saw the opportunity to enter this vertical and scale without compromising any on investment possibilities in the aerospace side. And it leverages, apart from leveraging the high precision capability which is required for molds and manufacturing, and also the assembly side of it. This is an opportunity to scale. It's a fairly large market, and where we it's about $80 billion global market on toys, and there are no players in India at that point in time significantly contributing. And we have entered that market. Later, we decided that we expand this into consumer electronics, where the opportunity is much larger than what we have seen. So, as a product portfolio, if you look at capability perspective, Aequs has always driven on the capability in the manufacturing or machining. We have stamping, and similar in the plastic injection molding is there. And in consumer electronics, we are doing stamping and precision machining and injection molding. So there is a combination which comes into the consumer side business also. And coming down to your question of, that's the reason we believe it's a complementary for us to leverage capability of what we have, what we learned in aerospace, and to apply for consumer. It's a much higher volume, and what has taken 15 years for us to grow in aerospace, this can happen within few years in the consumer industry because of the way the product scales in this industry. And the second one is on the consumer electronics, the consumer performance perspective. We've invested on this product in the consumer electronics over the last 24 months, and we just started product.
Participants, kindly stay connected while we connect the management back on the call.
Yeah, majority of the capacity has come online, and now because of that, our EBITDA looks much worse than what it was in the previous quarter. And as our utilization is today only at 35%, and utilization will continue to improve on a quarterly basis, you will see the improve in the EBITDA numbers and also profitability. And we have to work with this, and because early investment phase, and it is working through and making sure that we are going to get the utilization up and correspondingly translating into our profitability.
I have a follow-up question on this. Like on aerospace, you are making like you are profitable, but because of the consumer segment, your aerospace revenues, like margins, are getting wiped off. So, is there any plan like you are thinking to do something in future? Because I think in the plastic side, it's been consumer segment has been loss making since like a lot of time. So, is management planning to do something regarding the same? And like the second question is regarding the ecosystem. Like as it's highlighted that because of your ecosystem, which is the precision making, I'm a little confused that why it's not getting reflected on your margins. Like being aerospace company, you are making margins less than 20%, and like being like I just want to understand like how this ecosystem is helping you on aerospace side.
Hi, this is Dinesh here. Maybe I'll just take that question, and I'll just take the last part of the question. Again, if you see our segment results, if you see aerospace for the 9 months reported, it's at 24% margins. So the margins are, healthy there. So that's the margin that you should reflect. In terms of consumer, again, I think what we just mentioned in the sort of introduction is the manufacturing business requires investment upfront. So if I take consumer electronics or toys, I think the investments have been made upfront. If you see year on year, we are showing a steady growth in revenues. And with the revenue growth, you'll get a leverage and the margin should come back. So the focus, two things. One, on consumer electronics, already we have the customer in place. The products are getting industrialized. The demand is there, so we should see revenue growth. And with revenue growth, you'll see a leveraging of whatever investments we have made in terms of CapEx and people that we have got on board. It's a similar situation for toys as well. We have the fixed assets in place. So as the revenues grow, you'll see a leveraging and we should start getting into a good margin profile. I hope that addresses your question.
Okay, got it. Thank you so much.
Thank you. We have the next question from the line of Renuka Baid from IIFL Capital. Please go ahead with your question.
Yeah, hi and good evening, team. Congratulations for the results and IPO listing. But first question is on the aerospace business. Can you help us understand what are the timelines of execution of the order backlog which you have shared in terms of number of years? And also if you can share with us the guidance for fiscal 26 and if any you have for fiscal 27 for this point in time. That's the first question on aerospace. On consumer part of the business, it would be helpful if you can help us understand how is the order book with the key customers on the consumer electronics part of the portfolio which you recently added. What is the roadmap to scale the revenues in that segment? You did highlight that the segment earning profitability is contingent on the improvement in utilization levels. So basis the order book that we have, in your view, by when are we expecting the business to break even and turn profitable? And what is the kind of capex requirement in this business that you're forecasting for the next 12 to 18 months?
Thank you. For the first question in terms of order book, again, as you mentioned, the order book is $814 million. We expect this to get delivered over the next 5 years. So this order book is there up to about 20 or 31. Obviously, we continue to win new orders, so this is not a static number. But the number of $814 million will be delivered between now and 2031 as the projects start scaling up. The second question in terms of...
So we can consider this as the TCV value, right?
Yes, this is the TCV, total contract value. That's correct.
Sure. Thank you. Sure.
On the consumer electronics, again, in terms of order book, typically the structure with the customer is that we build capacity based on demand that they project. So typically the way it works is they have a certain demand. We work with them to build the capacity to sort of fulfill that demand, which is why I said the demand is already there and where you'll start seeing the ramp up in revenues. So there's no order book as such, but the way they work with their contract manufacturers, they build the capacity to meet their demand.
Sure. So based on the indications
just to add,
that you have on demand, yeah.
Sorry, go ahead.
So based on the indicative demand ramp up on targets that you have from the customer, in your view, how should we look at the growth or volume scale up in this business, and at what utilization levels, in your view, we would be the consumer business will be turning profitable or it will break even? And any timeline do we have for the same?
See, timelines, I think, we'll have to see as it goes. I think today, if you see, we are seeing a growth in the quarter. In terms of, again, what I can say is the capacity that we have built is already fully committed by the customer. Now it's a question of how our ramp meets that requirement. So there's no issue of demand. It's only our ability to scale at a quicker pace that will meet the demand. So that's the...
Sure. And and due to the ongoing memory chip price, both steep hike in the prices and availability shortages, have we seen any volume impact, or probably since we are in the early phase of ramp up, we are broadly unaffected by some of these macros
Renu, this is Arvind. Just to give you a little bit of broader on this thing. look, the products have been qualified in the consumer electronics, both the products, and commercial shipment has started. The customers are happy with where we are, and in fact, they have asked us to increase our capacity. So the combination, obviously there's no issue with the market share perspective, volume perspective, because we are a very small percentage of the overall market share of the customer. Okay.
Correct.
And so
Got it.
we don't see that as an issue at this point in time.
Sure. And second question would be, given that India has now signed up with EU on the FTA, we also have a subsidiary, when we have a French unit there. So in any way, do you think our portfolio tends to benefit on any import of certain components coming up for Europe, or especially on the aerospace part of the business?
Actually, aerospace itself did not have any kind of a tariff between EU and India. It has been 0-0. And whereas consumer toys has certain tariffs, certain products have. Consumer electronics typically don't ship to Europe. And obviously, our customers, since our contracts are always Ex Works or delivery duty unpaid, customers typically bear the duties. And in that situation, we become more competitive in this situation when the tariff, whatever the 4-5% is there, goes to 0, in those areas.
Correct. Got it. And lastly, to close, would you like to share any guidance on revenue margins for fiscal 26 or anything for fiscal 27 at this point in time?
No, not at this time.
Sure. Thank you. Thank you, and best wishes to you.
Thank you.
Thank you. We have the next question from the line of Nemish Sundar from Elara Capital. Please go ahead.
Yeah, hello. Yeah, am I audible, sir?
Yes.
Yeah, sir. Congrats on a very healthy set of numbers on growth. So just a few questions. So on the order pipeline, on order book, you highlighted USD 814 million is the current order book in aerospace. I just wanted to understand how would be the ramp up in order book, like is there any order pipeline that we could work with for the next 1-2 years or the upcoming quarters, or how would we go about that? Any indication?
Yeah, I mean, this is a constant process. Our sales team is in the front, our customer engagements are continuously, our account managers are working with our customers to, RFQ pipeline continues to happen, and we convert some of them into contracts every quarter, and that gets added into our order backlog, and that's what we will communicate every quarterly basis. What's our current order backlog, order book looks like, and so you'll see that continuous update on a quarterly basis, and it's a continuous process. Every quarter it moves up, whatever it is, depending on what we executed plus what we signed up.
Okay, so it could be in tandem with what the revenue growth is currently there, and it would move along the same lines as what we could work with. Is that a fair assumption?
Yeah, I mean, look, these contracts are anywhere between 5 to 7 years when we sign new contracts. Some of the contracts signed long back would be ending, and new contracts renewals would have happened. All that combination will come up, and obviously it's a measure of what would we deliver in next 5 years.
Okay, sir. And on the capex requirements, so what would be the capex that we could assume for this year and for aerospace and consumer, if you would like to provide a split of the capex?
So this year you should not, most of the capex is already done. There will only be some more capitalization. So the spend has happened. Some more capitalization will happen in the consumer electronics. But otherwise, we should not see any big capex, new capex that are coming in. So you'll see some numbers that are getting into capitalized in Q4. But otherwise, there are no significant investment in this year.
Okay, and just my last question on the component manufacturing scheme approval that you have mentioned. So I just wanted to know for what product or segment, if any particular segment was this for?
This is for a consumer electronics segment, mechanical enclosures.
Okay, fine. Okay, thank you, sir.
Thank you. Ladies and gentlemen, if you have a question, please press star and 1 on a telephone keypad. We have the next question from the line of Dev Thakkar from iThought PMS. Please go ahead.
Hello, am I audible?
Yes.
Thank you, sir. Congratulations for the listing, and thank you for the opportunity. So I had this question. So what would be our wallet share in absolute terms per aircraft, maybe the narrow body ones, and going forward, what could be the growth in this per share aircraft?
Look, we are not currently disclosing the exact content per aircraft at this stage. Obviously, I can qualitatively say that Airbus A321 is a significant content as overall revenue perspective for us, Airbus A320 family for us as a Aequs. And narrow bodies overall is generally a largest market, largest revenue share what we have today. And it continues to be because the volumes are largest in the industry. And also growth is also highest in the single aisle market, which is predominantly Airbus A320 and 737. Both are growing in the volume. So that will continue to have a larger share for us also and winning opportunity also for us. But having said that, we have enough content of long range, both on 350, 787, 777, 777X, and that's the overall narrative I can provide.
Okay, got it. Could you provide a mix of like what could be the one-time delivery part and what could be the repeat business parts of this?
We don't do any one-time delivery parts at all. We generally everything what we do is under contract, long-term contract.
No, as in like what could be the for the fresh aircraft and what could be for the MRO business part?
Aftermarket. We don't really push that because everything we deliver is under contract to the OEMs or tier one, and it's left to them. And we have no differential pricing, at least out of India. Little bit, I would say, in our French facility, we segregate between MRO and aftermarket and OEM, and then there is a content which there obviously it's a differential pricing, and so that's how it works.
Okay, sir. Sir, on the consumer electronic side, is there any change in capacity? For enclosures, if I'm not wrong, we had 10,000 per day capacity. In worst cases, we had 4,000 per day kind of capacity. Is there any change in that? As you said, capitalization is still yet to be done. So what could be the final capacity for that?
Yeah, I mean, look, we have no comment on that specific activity question.
Okay, got it, sir. Thank you. All the best, sir.
Thank you.
Thank you.
We have the next question from the line of Shashikant from Brighter Mind Equity Advisors. Please go ahead.
Thank you, sir, for giving me the opportunity. My first question is client-wise breakup of revenue, if you can tell us, I mean, from Boeing, Airbus, and...
Yeah, I mean, we don't provide that that split.
Okay. Sir, the next question is, recently we have observed many Indian groups are trying to, build a commercial manufacturing in India, commercial aerospace manufacturing in India. So how we are seeing that opportunity?
We would be happy to supply to anybody who does commercial aerospace or aircraft build. We have no issue with it. Ultimately, these are all approved by the OEMs. If I'm supplying to the OEM, all these designs are not done in India. These are existing designs getting built in India. So if we are supplying to that original design, those same parts will end up coming here, supply, if they set up a facility there. So it just translates.
Okay. And how we are seeing about the opportunity in the defense aircraft manufacturing in India?
Look, we have capacity to support anyone. Its question comes down to is we want to, in the defense side of it, we would like to be more of a system level contributor. That's why we announced a joint venture partnership with Axel and Vegas defense to get into the UAV market, design and manufacturing. We believe we would like to play at a system level in that segment, in the India defense specifically. We do support the defense activities in France and US locally also.
Okay. Thank you, sir. That's all from my side. Thank you.
Thank you. We have the next question from the line of Sharon P. from Unifi Capital Private Limited. Please go ahead.
Yeah, hope I'm audible.
Yes.
Yeah. So my question is on the consumer side. So on the consumer side, we have toys and electronics, right? So the cookware business we are doing, we are JV now. So my point is, how much of a rough mix would be of this quarter or for the 9 months would be from toys and from electronics? And second question would be, from toys perspective, one of the TV interviews I heard you say that you are in line with increasing and bringing on some new customers for the toys business. And how is that going? And how is the Hasbro's business currently? Because we saw a dip in the last year, but again we are seeing that Hasbro is planning to shift again from China to India. So whether how is the growth in the toys business? And third one would be the electronics business. I can understand that once the ramp up comes, we would be seeing the profitability. But how do we see it? Maybe in how many months or how many quarters roughly we can get to achieving that ramp up? If you can comment on any of the steps.
Let me maybe try to answer this question. The consumer side, you're asking how much is the toys versus the consumer electronics. We don't split that number because predominantly is evolving vertical for segment for us. And today I can say that the consumer electronics is a small portion of the overall 9 months, and we believe it's going to accelerate much faster, and it's going to be a significant portion of our consumer business as we go forward.
Okay.
And a toys perspective customer basis, we are onboarded Mattel as a new customer.
Okay.
Strategically long-term agreement signed in, and we believe Hasbro is also growing, and will continue to grow both of them. That's how we look at it. And we have existing capacity. We are not investing any new capacity in this vertical at this stage.
Oh, yeah, I get that. Okay, so Mattel, so when will the revenue kick in? Like
we already started the revenue.
Already started the revenue. Okay.
Q3.
Yes, okay. Q3. Okay. Good. Thank you. And on the last one, when would be, at least on a PAT basis, we would be break-even for consumer, or else when we will be achieving the revenue potential in consumer?
Sorry, we couldn't hear that properly.
No, so when we would be PAT break-even in consumer segment, and when we'll be achieving the revenue potential which we are aiming in consumer? Maybe a rough estimate of how many quarters down the line we would be there.
Yeah, we cannot put that exactly at this point in time because our utilizations are going up. It will take some more, and also same time our customers are happy and asking us to increase their capacity. So we have to bring those equations together to figure it out, how it works out. And we need some more time to get to that answer to that question to Parth. This exact point in time.
Okay. So maybe one last question on the aerospace segment. What would be our recurring capex? Because it's a growing, so capital intensive business, I understand. So what would be the recurring capex which we would be incurring year on year? In line with depreciation, or whether they would be incremental?
The capex in aerospace you're asking?
Yeah, because it's a capital intensive, we will be recurring it continuously. Whether it will be in line with depreciation or there will be an incremental capex on top of depreciation.
I mean, it depends on the programs we sign up. Obviously we want to utilize. We have some headroom in the utilization today, and we're at 70% in India utilization. We have opportunity to go up to 75% still, and the capex evaluation happens on a continuous basis. Because the growth opportunity is there. More parts we take, more programs we take at this stage is a fairly a good lock for us for long term, and we would like to take as much as possible, and our ability to take on.
Okay. So aerospace 75% potential. So what will be the potential for consumer?
Mr. Sharam, I'm very sorry to interrupt you. Could you join back the queue, please?
Yeah, sure. Thank you.
Thank you. The next question comes from the line of Jay Chauhan from Trinetra Asset Managers. Please go ahead.
Thanks for the evening. Am I audible?
Yes.
The first question is, what are typical consumer segment gross margins for toys and electronics?
Sorry, we couldn't hear you properly. Can you repeat that, please?
Sir, I asked what are typical consumer segment gross margins for toys and electronics?
So, long term, once we reach an ideal utilization, our margins will be broadly in line with aerospace. So you can model around that. Just to again clarify that, if you see capability in consumer electronics and aerospace, capability is very similar. Again, the processes are same. It's machining, surface treatment, all of that is similar. So the margins also will be on similar lines.
Understood, sir. Understood. And on the aerospace side, when you said major revenue is coming from Airbus, which product are we exactly supplying to Airbus?
I mean, we have more than 2,000 part numbers to deliver to Airbus, across across various divisions of Airbus UK, Airbus France, Airbus Germany, and it's wing components, the fuselage, various components we deliver. So that's a very broad question, and some we deliver indirectly also through their tier ones like Safran. So there is a combination of parts. We have 5,000 parts were all delivered to our customers, and over 2,000 for Airbus.
Understood. Because I think I saw that you are supplying doors to Airbus in your investor presentation, and I have heard that I guess Dynamatic Industries also won a huge order for all the doors. So is it a different program, or are you aware about this?
Yeah, in fact, we also supply to Dynamatic. Dynamatic is also our customer, and
Understood.
we work on a different program.
Got it. Understood. That's it from my side. Thank you.
Thank you. The next question comes from the line of Sahil Sangari from Private Family Office. Please go ahead.
Hello. Yeah, hi, sir. How are you? I just wanted to ask a question that, I believe that Aequs is also part of the Apple supply chain, the Apple ecosystem for watches and the MacBook. So where exactly are you placed right now in the whole agreement, and have you started supplying items to them? And is it a permanent contract which you have with them?
Look, in the consumer electronics industry, pretty much we supply components. As mentioned earlier, we are a part of a consumer electronics ECMS scheme, which is recognized for the mechanical enclosures, and that's a core area for us. It's the mechanical components we supply to the consumer electronics industry. That's all I can comment at this point in time.
And capacity that we have built is underwritten. Yeah. So in terms of demand, there's no concern.
Okay. Got it, sir. Thank you.
Thank you. Next, we have a follow-up question from Bhavika Singhvi from Niveshaay. Please go ahead.
Hello. Yeah, thank you so much for the opportunity.
So basically, I want to understand the margin breakup, like, because in consumer you have three different components to deliver, like consumer electronic, plastic, consumer durables. So can you give the bifurcation of approx margin, like how much the particular segment is contributing? And the other question is on the aerospace, like, because we know that in aerospace, even though you have like 5,000 plus SKUs, I just want to know that does like Aequs hold any sole supplier status for some of the components? If you could provide like guidance on that.
So to the first question, this is Dinesh here. The first question, again, like we said, at a consumer overall on a segment basis, you should see at a steady state with ideal capacity margins similar to aerospace, which is about 18-20% EBITDA margin. So that's what we should look for. In terms of the single source, I'll just hand over to Rajiv to address that question.
With respect to the single source, we are over 90% on the parts what you mentioned, number of parts we mentioned for aerospace.
Okay, and I just want to know, like, because like there are like you supply to tier 2, tier 3 suppliers, and even the tier 1. So can you provide the bifurcation or breakup of the same, like how much comes from the tier 1 or tier 2, 3 suppliers?
See, we can't provide that bifurcation, but generally, if you know, they're only Airbus and Boeing. Whatever goes to these two people at the end of the day. So, and from tier 1, tier 2, wherever we deliver will go at the end of the day to these two guys.
Okay. Thank you. Okay.
Thank you. Ladies and gentlemen, if you have a question, please press star and 1 on a telephone keypad. I repeat, ladies and gentlemen, if you have a question, please press star and 1 on a telephone keypad. The next question comes from the line of Ashok Kumar, an individual investor. Please go ahead.
Hi, congratulations on great set of numbers. I have two questions actually. The first one is basically during the pre-IPO interviews or the interactions by the management in the public, actually management was guiding for the overall PAT positive will be achieved by the end of FY27, if I'm not wrong. So are we still on track to achieve that guidance?
I mean, look, our overall PAT is driven, PAT positive being driven, will be driven by the consumer electronics maturity. And there are some dynamics which are coming in, which especially with the customer being happy and asking us to increase the capacity, we need to make that call, evaluation. You know, how does that play out into our profitability timeline? That's the reason we earlier said we need some more time to make that call on the timeline of consumer electronics profitability. Whereas aerospace continues to increase profitability, and without consumer electronics achieving the profitability will make that overall consolidated based profitability, because aerospace continues to grow and our losses will start coming down. So we cannot give exactly at this stage.
Yeah, understood. So just a follow up on that, I know since now you are looking for more time to give this guidance or the clarity because of the positive surprise which we are receiving from the customers. But only thing is that we need to recalibrate and then reevaluate the path to the timeline to achieve that. But it is on the positive side of it, not on the the other side, if I understand correctly.
Yeah, I mean things are not things are going well. So obviously customer is asking us to look at more capacity that has an impact on the timeline. Because capex comes with the capex and depreciation and capacity addition. So
okay, got it. Though we are getting a new customer capacity addition request, it may drag a timeline a bit because of the capacity addition and the respective depreciation charges, so on. Yeah,
it will be just choice for us, how we what path we take.
Okay. So can we expect this clarity in the next conference call by any chance?
I can't because there is another element of utilization also, which we have to factor in. Utilization is growing continuously, and we saw last quarter of this call, utilization has grown, and we will continue to work together to figure out what it means.
Okay, sir. Thank you very much. That's all. That's all I have. And once again, congrats on the great set of numbers on the growth front.
Thank you.
Thank you. Next question comes from the line of Ashish Upkanlavar from InvestQ PMS. Please go ahead with your question.
Yeah, thank you for this call. Sir, this is preliminary for me to understand, so my questions would be elementary here. Just wanted to understand what kind of scale of business that we are targeting maybe 3 years out, because one of our divisions, consumer division, is in a scale-up phase, and the other business is in a growth phase. So where do we plan to reach maybe 3 years out? And as you said, the margins on a optimal utilization basis might be around 18-20% that one would target. So how far is that? If these two questions can be answered, please.
I would answer it in a way. What I can say is our goal is to balance the consumer and aerospace business in a long run, and we want to get there as fast as possible because that's an opportunity we have. That means we have to scale consumer side faster. It will happen because that's how the nature of the business is. And obviously the margins, we are guiding always that consumer and aerospace will have similar margin profiles when you're at a scale. And those two are, that's the 2 points which I want to make. I hope that answers your question.
So, sir, just to put that in numbers, I think we've done something like 800 odd crores in the first 9 months. So we are on a run rate probably of 1,200 crores on the sales, right? So where do we see? 3 years out, maybe is on a conservative basis, say 25% is a right CAGR to assume for your company, or is it likely to be higher? Some direction on that would be helpful to us to understand.
At this stage, if you see that we have opportunity to grow north of 20% in our aerospace business, what we are seeing, what we are guiding, and obviously consumer has much faster than that, so that we point in time.
Got it. So would love to meet you and understand the business in greater detail. This call is good to have a basic understanding, but would look forward to meet you guys sometime.
Yeah. Please reach out to our investor relationship team and,
Sure. Thank you so much.
Thank you. Yeah, the next question from the line of Rachna P, an individual investor. Please go ahead with your question.
Hi, am I audible?
Yes.
Yeah, hi. Congratulations, sir, on a good set of numbers. My first question is on your EBITDA margin profile on your aerospace segment. So if you could just help me understand, from what I understand is that you're a tier 1 supplier to OEMs. So I would expect that the EBITDA margin, you would have some sort of a pricing power. That's how we understand the industry. So, but compared to a few other players in this industry, we see a margin profile at around 20 to 24%. So is that something which is going to improve going forward, or is this the base that we should assume going forward?
See, again, the specific question, for the 9 months, our margins have been 24%, and we continue to see the margin range in 20% plus range. That's what we see. I think important thing, while we will not comment on other companies, I think important thing to see is the scale at which we are operating, which is significantly larger. I think the competitors you're referring to. So we are comfortable at this level, and also you have to remember we have a ecosystem which has multiple capabilities. So all of those call for investment. But the advantage is that gives us a deeper sort of insight into the customer. So our global presence is also a cost structure, but that gives us a better traction with the customer. So those are the differentiators. If you see the ecosystem and global presence, gives us an advantage in terms of being a long-term partner to the customer at a very large scale. Just to add again, all our investments are larger scale, so we don't do in a smaller scale. So those initial costs will be there, but this gives us a longer-term relationship with the customers.
Okay. But 20% plus is what we should expect even going forward.
That's correct. That's correct. That's correct.
Got it. So one more question would be that, since we have a huge backlog, right, order backlog, but even in the aerospace segment, we are seeing a 65% utilization. Could you help understand that? Like, why is the utilization not higher?
Yeah, sorry. So, with respect to the aerospace, currently our utilization in India is around 71%.
Right.
Overall, generally we see a utilization of around 75%. That's where we guide our utilization to be reaching as a maximum utilization.
Okay. All right. Thank you. Thanks for answering my questions.
Thank you. Next, we have a follow-up question from Dev Thakkar from iThought PMS. Please go ahead.
Hello. Thank you, sir. Sir, on the aerospace side of things, how should we look at the high value-added products like the landing gear system and engine system? Going forward, what are the plans on these segments? What could be the, maybe wallet, as in revenue share and margin improvement? Any broad idea on this?
Look, I mean, today, a majority of our aerospace business is aerostructures. And as a part of our stated strategic objective is to expand into a landing gear and engine components, which we already do, by the way, in French facilities predominantly. That's what they do. And in India also we do. And our vertical integrated ecosystem, especially forging and machining combination and surface treatment, is very suited to do the landing gears. And we are engaged with all our landing gear customers, key landing gear customers, and that's an opportunity for both on engine and landing gear. And more vertically integrated, we will end up doing, better on overall margin perspective.
Got it, sir. Just one more follow-up. As you said, our capacity utilization are at 71%, and stable utilization could be 75%. So going forward, in FY28, can we see CapEx in the aerospace segment?
There is a CapEx which continues to happen in the aerospace. We had CapEx last quarter, Q3 also, and you'll see some in Q4 also. But it has continuous CapEx. It's not a lumpy CapEx in aerospace because customer orders, we win orders and we look at the capacity over 18 months. What is required because the lead times to get machines in aerospace is long. It could be as much as 1 year for us. So we plan to 18 to 24 months out capacity demand and based on the order book what we have and what needs to be executed, and that's how it is done. So, we keep adding machines.
Got it, sir. Got it. Thank you so much.
Thank you. Due to time constraints, that would be the last question for the day. Now I hand over the floor to the management for closing comments.
Appreciate for all of you joining our first call and look forward to engaging further with you all during the course of the quarter and in the future. Thank you.
Thank you, sir. Ladies and gentlemen, this concludes your conference for today. Thank you for your participation and for using Boosaba's conference call service. You may disconnect your lines now. Thank you. Now, pleasant day.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.